Hello everybody, another week, another dollar. Today is Sunday. Hope you're all enjoying your weekend. These are the top 5 things I'll be watching in financial markets in the week ahead. Kicking things off with number 1, the coronavirus outbreak and worries over its impact on the global economy are likely to remain the main drivers of sentiment in financial markets in the week ahead. Really, headlines surrounding the outbreak have kept investors on edge lately, and that has obviously been reflected in financial markets. We saw that the number of total infections worldwide crossed the 106,000 mark, with the total number of deaths nearing 3,600. The situation continues to worsen outside of the epicenter of China, with more and more cases and deaths being reported across Asia, the Middle East, Europe, and the U.S. Over the weekend, Italy took some drastic measures to contain the spread of the virus, essentially putting around 14 cities in the country's northern region on lockdown. And in the U.S., California and New York have both declared states of emergency as the number of infections continue to rise in those 2 states. So again, as we get updates regarding just how fast the disease continues to spread around the U.S. and Europe to a greater extent, that will continue to sway market sentiment in the coming days. In my opinion, as long as the coronavirus outbreak is prevalent in the markets and governments around the world take actions to contain the spread of the virus, we'll continue to feel the economic impact from the disease. On to number 2. Markets on Wall Street will be in focus, or actually volatility on Wall Street will be in focus after really suffering one of the wildest wild roller coaster weeks on record last week. We're expecting further volatility on Wall Street in the days ahead. We saw daily swings last week, with the Dow jumping 1,000 points and dropping 1,000 points. Daily swings which we haven't seen since the depths of the 2008 global financial crisis. We do see that unofficial figures are currently showing that the Dow is set to open about 500 points lower when the futures markets open on Sunday night. So really, we see that the volatility is likely to continue, and we'll also continue to track movements in the bond market, where wild swings are going on over there, as well as the 10-year bond hit an all-time low nearly every day last week. So we'll continue to watch that. If a risk aversion continues to pick up, just how low can the 10-year yield go? On to number 3. Staying with the theme of volatility and turmoil, oil markets plunged 10% on Friday, its worst daily loss since 2014, as the 3-year agreement between OPEC and Russia just unraveled after Moscow failed to support Saudi Arabia's plan for further production cuts. Some speculation, chatter over the weekend revealed that Russian President Vladimir Putin may have been single-handedly responsible for the collapse in crude prices on Friday. Some are saying that as the Saudis tried to convince Russia to go along with further production cuts, Putin pretty much insisted that U.S. shale producers, which haven't been part of the production cut agreement over recent years and has seen their production surge, should also be a part of the plan. So basically, Putin ditched the Saudis in order to start an all-out war against American shale producers. In response to that, the Saudis on Saturday cut their prices on all crude for shipment destinations in April. In addition, they announced that they are likely to boost production to well above 10 million barrels per day starting from next month. So really, all are saying that the equivalent of the declaration of war in oil markets, we're likely to continue to see further downside movements in prices as the developments really revive fears of the 2014 oil crash. What is $25 oil really something in the cards? The way things are going and the way the coronavirus has slammed demand, that is not out of the question. So keep your eye on commodities markets as well. On to number 4. We also have some data and earnings to react to this week. In the U.S., the main focus on the economic calendar will be inflation reports. We get CPI figures on Wednesday, followed by PPI numbers on Thursday. And in earnings, while the Q4 earnings season has all but died down, we get some reports from a number of key names this week. Some of retailers include Gap, Dollar General, and Dick's Sporting Goods, while some of the tech names reporting this week include Slack, Broadcom, Adobe, and Oracle. So it'll be interesting to see what Oracle and Broadcom have to say about their supply chain and how sales are holding up in the face of the coronavirus panic. And finally, number 5, in central bank news, all eyes will be on the ECB meeting on Thursday. Most are expecting the central bank to hold steady on rates as the ECB is already well into negative territory. So essentially they have less room to cut when compared to other central banks. But it will be interesting to see what Christine Lagarde, the ECB president, has to say, and whether she will reveal anything in the post-meeting press conference regarding further easing and QE. We saw last week the Fed had cut emergency rates for the first time since 2008. We had rate cuts in Australia and Canada as well. However, so far, efforts by global central banks have not been able to stop the selling in stock markets and provide a sustainable rebound. So it'll be interesting to see with markets expecting a 75 basis point rate cut from the Federal Reserve later this month, how those odds in the Fed funds future markets shift in the week ahead. That's it for me. May the trading gods be with you. Have a great week, everybody.